Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from the Chicago area. Welcome back to the show, Eric.
Well, thanks for having me back, Jim.
Eric, have high-tech stocks fallen out of favor, and are we back into basic commodities?
Well, I do think that there has been a slow shift going on for some time, and I even discussed kind of the overall wave structure that I see in indexes like the Nasdaq 100, which are a good representation of those tech stocks, where, from my outlook, coming into February-March period, I thought we were going to see a rally up to about 14,000 in the Nasdaq 100 into April, and a multi-week top there, and then potentially a final rally that could stretch into June, with a upside objective around 14,500 to 14,600. So if that's accurate, it would mean that there's not a great deal of additional upside potential. And the way that the overall wave structure is unfolding, it's like a series of fifth wave peaks on different magnitudes leading up to a final top. And so I do see a lot of what you're describing, where the tech stocks are certainly struggling to add to their gains. They had, some of the biggest gains in the second half of last year, so it's not unusual or unheard of to see some of that rotate out of tech. But I think there's also some other underlying factors at work too. You've got a combination of, things opening up, so those tech darlings that really benefited from the stay-at-home, work-at-home phenomenon, they're starting to lose some of their luster. You've got parties in power that, going back over recent years, they have been vocal about their opposition to some of the big tech giants, and even floating ideas like trying to split some of them up. And I'm not saying any of that is necessarily imminent, but you just have some headwinds starting to come towards the tech stocks, and so it's taking more for them to add to their gains than it is other stocks, commodity stocks like you mentioned, and I think that's going to continue.
With this demand for basic materials, lumber, was that expected to see such a big jump year to year?
No, I had no idea that cycles certainly turned positive early last year, and was expecting a sizable rally, but nothing like the magnitude of what we've seen. And you had such a combination of both supply disruptions because of COVID, and then the increasing demand from everyone suddenly doing home improvement projects. And now you've got builders that are in many areas of the country, like where I'm at, the cost of lumber has become so prohibitive, and houses are moving up in price, but from a lot of builders' perspective, they need those comp values to not only catch up with the current costs and reality, but to maintain there long enough to where if they start constructing houses that are going to cost them $20,000 to $50,000 more in materials, that they're pretty confident they can get that at the tail end. So the reason I mention that is that you could still see the demand on lumber remain strong, because a lot of those builders are only kicking back into gear, and there's been a very high demand for homes, especially out in some of the suburban areas around big metropolitan cities. And so it doesn't mean that the price of lumber will continue to head up, as supply comes back on the market and other disruptions get mitigated. You'll see prices certainly plateau and eventually come back down, but I could see the demand staying there for a reasonable amount of time.
Could we see a change in the materials used for home construction? Stainless steel and glass are the two things that will last the longest, so a house made out of wood will deteriorate. If it's stainless steel and glass, it's not going to. Maybe some Arthur Erickson inspired designs where you have a lot of glass and framing and not your typical wooden white picket fence and so on.
Well, it sounds like you know a lot more about that than I do, and any shifts like that take quite a long time to really have a measurable or significant impact. So even if you saw something like that in society, it could be 5 to 10 years before it's even having a significant enough impact to really hit the cost of those raw goods and the demand for them. So I don't know enough about those specifics to really comment intelligently on them.
Well, there's actually an app that you can get on your phone now that will match the cost of lumber versus using steel.
Yeah.
So somebody has actually thought about the same thing I just thought of, something that people have to look at. We'll take a look at interest rates and the U.S. dollar when we return.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Eric Hadik. Treasury boss Janet Yellen is hinting that interest rates are on the way up, maybe not tomorrow, but very soon, probably. Really, does the U.S. Treasury or the Fed have any control over interest rates, or do they have a cycle of their own?
Well, they're often responding to what the market has already dictated, and trying to hold back when they need to hold back, or move ahead when they need to move ahead. But from a cyclic basis, I am still moving forward with the same expectation that I've described the last 2 years. And all of my work was showing and continues to show that interest rates were poised for a major multi-year bottom in June or July of 2020. And that was the latest phase of just an uncanny 4-year cycle that has timed critical turning points in interest rates for 30 years or more. The most recent pair of similar cycles were in mid-2012 and mid-2016, and each time they timed a multi-year peak in bonds and low in the corresponding interest rates. And that's why June, July of 2020, I was expecting the same thing. And that's what we have seen so far with the initial move up in interest rates from July of last year into late March of this year. And I do think that there is a slow dip in rates and rebound in bonds unfolding now. Bonds have been going through a little bit of a basing period, and I've been describing why I think that you'll see bonds rebound into late June, early July, so that would be a corresponding pullback in the interest rates. But after that, I think you've got another sizable move, probably 9 to 12 months to the upside in interest rates, to the downside in bonds, that should take you into mid or later of 2022. So my work would certainly tend to dovetail with what Yellen is saying and what the likelihood is for interest rates in the next year. And I think that's going to have an impact on all kinds of things, from bonds and stocks to commodities. But it does look like interest rates have seen a multi-year bottom, and that on balance they're going to be heading higher. What I said from that 4-year cycle low in mid-2020 was that you would probably see a 2.5 to 3 year upswing in interest rates, and then a pullback into what would be the next phase of that 4-year cycle. So looking for a subsequent low, although I would expect it to be a higher low in mid-2024. So the way that 4-year cycle is unfolding and expected to unfold, I would think we've got another year to 12 to 18 months to the upside in interest rates, and then something knocking them back down in maybe mid-2023 to mid-2024.
Does that mean another major recession is going to hit then, or some other force?
It when you're discussing cycle lows and highs like that, I really warn my readers that you need to not write anything into or out of something like that. All it means is that in mid-2024 we should have a subsequent cycle low. It could be as simple as interest rates getting a little ahead of themselves over the next year and a half, and then they just have to pull back to an equilibrium point. There may be no big economic or financial impetus for that, or it could be. That's where price action and a lot of other indicators I use have to give specifics. But when you're talking about just the timing, that's all it is. It's just the timing. And so in between, I'd have to first see what happens between now and mid to late next year before even being able to formulate some expectations for 2023 and 2024.
What kind of an impact is that going to have on the U.S. dollar?
I do think that that's going to be one of the factors that begins to support the U.S. dollar, which I think will bottom very soon. I have been talking about a very consistent 36 to 38 month cycle in the dollar, and it precisely timed the last two peaks in 2017 and 2020, but a similar and related one was anticipating a 6 to 12 month or greater or longer low right at the time frame that we're in now. And so I think the dollar is getting very close to a bottom, and that both interest rates and the economic activity and recovery that is probably going to help spur some of that move up in interest rates, that both of those factors I think will begin to support the dollar. And there could be certainly opposing or contrasting negative things on some of the other currencies that might also factor into that. But I think that interest rates in the U.S. could be one of the primary factors in supporting the U.S. dollar over the next year or two. And I think that in itself is going to have then a correlative or, residual impact on other things like even gold and other markets that ultimately are influenced by interest rates and the dollar.
We'll have more with Eric Hadik right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Eric Hadik. Eric, what do you expect to see with gold and silver?
I have, for the last several years, been focused on two time frames that I thought would give the final two peaks in gold and silver. And so this is a bull market that began in late 2015, early 2016, went through a basing period like most bull markets do, where you see some upswings in 2016, 2017, 2018, and then really began to take hold more in the most recent couple of years. And throughout that, I explained why I thought that late 2020 and around May, June of 2021 were critical cycles where I thought we would see some important tops in gold and silver. They both saw strong rallies into August of last year, fulfilling the first of those cycles. And now I think they're on track to fulfill the second of those cycles, although there are some markets, silver being one of them, that could potentially stretch a final high into August, September of this year. But I expect an initial peak here in May, probably within the next couple of weeks, and I've got some price targets that I've explained in my newsletter, which I'd be happy to send a copy to any of your listeners. But also the overall wave expectations and how some of these indicators are coming together to pinpoint how and where gold and silver appear likely to peak in the next couple weeks. Gold has been very consistent in adhering to, it's done this trading in ranges that I discuss, and even since its peak in August of last year and then right down to its low in March of this year, it has evolved in these approximately $80 ranges. And it'll trade in one of those ranges for a while, and then when it breaks below or above the parameter for that range, it very quickly drops to the bottom of or rallies to the top of the next range. And so if you look at gold just in recent price ranges, 1840 is one of those parameters. And after the peak, even before the peak in August of last year, 1840 was critical support. Gold took off from there. After it had peaked, it came back through a couple of those. 1920 was the next higher level on an $80 basis. But it dropped right to 1840, played there between 1840 and 1920 for a while. Then when it broke below 1840, very quickly, it was down to 1760. And then it sat and vacillated between 1760 and 1840 for a couple of months. And when it finally broke below 1760 back in February, March, it targeted a drop to 1680. Sure enough, went right down to 1680 and bottomed there twice. And where did it rebound in between twice? Right to 1760. So if you look at the trading range, I'm looking at the June futures, which is what I'm focused on right now. But in early March, gold went down to 1680. By mid-March, it was back up to 1760, held there, dropped right back to 1680, held there, rallied right back up to 1760 in early April. And I explained how we needed to break above that and shoot up to 1840, which is where a lot of other indicators were coming into play too. I always stress synergy just because I'm describing one cycle or one indicator. The only reason I'll start discussing it is because there are already a lot of corroborating factors pointing to that same conclusion. And so gold has been on track. It broke above 1760. Now just in the last few days, in late April, it came right back down to 1760. I thought that was going to hold, and it has continued to, and now I think it's going to shoot up to 1840 in the next week or so before mid-May. And that's going to be a very pivotal area for gold. Like I said, there are some other factors coming into play there, and what gold does at that level is going to reveal a lot about what to expect through the rest of May and probably June and July. So that is one of my key focal points in gold. Silver, I think, has a bit more strength and a bit more upside potential, but I do think that this mid-May period is going to be a very decisive one for precious metals.
What's going on with cryptos and Bitcoin?
Well, I explain or I describe one scenario that I watch in all of the currency-related markets, and I sometimes equate it to a game of rock, paper, scissors. I also explain it as an algebraic equation where when A plus B equals C, or when A times B equals C, then anytime one of those factors changes, the other two have to change to make that equation still an equation, and equal, both sides are equal. And what I'm getting at there is I've seen for quite some time now this scenario where you have, for years, for decades, you had the battle between fiat or paper currency, debt-backed currency, versus hard assets, mainly precious metals, gold in particular. And so then it was a little more simple algebraic equation. But then in recent years, you've had digital currency come in there, and it hasn't completely melded with something like gold and silver, certainly hasn't aligned with the dollar, so it's kind of its own third entity battling for currency supremacy. And so what I described is that you will often only see one of those three, and I'm talking about the US dollar, gold, or Bitcoin / cryptocurrencies, only one of them be in a big trend at any one point in time. And when one of them is, the other two are kind of battling it out on a secondary level. And so even for the first few months of this year, you had Bitcoin on such a tear to the upside, and gold and the dollar were they were having their moves in both directions, but not really anything significant. And now as we've come into this time frame when gold was bottoming, I thought that Bitcoin, I had described why 65,000 was a key 3 to 6 month upside target for me. We hit that in mid-April, and now Bitcoin has gone into more of a consolidation phase. It really, that trading range dates back to late February, early March, although it was a consolidation with new highs still being set until mid-April. And I think that Bitcoin has the potential, and this is actually hinges pretty decisively on the price action of May 5th through 7th, just a couple of trading days there, that Bitcoin has the potential to turn back down. It's been bumping up about against 58,000, 59,000. If if it fails to exceed 60,000 in the coming days, and if it can turn a couple of indicators down in those couple of days, I could see it drop as low as 30,000 in the coming weeks or months. But again, that still is one of those if-then scenarios that there's a setup here technically, but it still needs to be triggered to validate it. And if it is triggered in the first part of May, then I could see another sell-off, kind of like we got between mid-April and late April.
Some people seem surprised that crude is strong right now. Is it a surprise to you?
No. The cycles in crude they were actually closely aligned with gold and silver, and even with stocks for that matter, that everything was pointing to a part of it's an inflationary scenario, and part of it's economic recovery. They kind of go hand in hand. But leading into May, June of 2021, and that's when I thought the energy market would continue its rally into May or June. Most recently, I've been talking about some extreme upside targets on a weekly basis in crude around the $70 level. But on a monthly basis, there's even a small percentage chance that it could spike up closer to 75 before a very significant peak takes hold.
Eric, thank you so much for chatting with us.
Well, thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. If you have any questions for Eric or any of our other guests, you can send them to info@HowStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.